Great to have you with us. And while it won't be as busy a day in the markets, there's a lot to talk about. The fact that, as I just mentioned, we've seen all-time highs for both the S&P 500 and the TSX. Investors have definitely been in a buying mood, and there's never any shortage of stories to navigate, including what we were just talking about, this big budget win for the U.S. President Donald Trump, and we might hear a little bit more about that today. For all things market-related, let's bring in one of the longtime BNN Bloomberg guests. Richard Croft is Chairman and Chief Investment Officer at Croft Financial Group. Richard, great to have you back with us. And let's start with, it's a bit of a slower day here, a moment to reflect on where we are. We've seen huge moves for stocks off the April lows. What have you been thinking about?
Well, there's a number of things out there. Certainly, we still have a lot of uncertainty over the fall. I think that's kind of where we're at. We've brushed past the tariffs so far in terms of the impact it's having on the U.S. economy, and there is questions as to whether it is going to have as dramatic an impact as a lot of people feared from the outset. Interest rates are another issue. There are some bullish aspirations that rates you could have a cut in rates in July. I think it was interesting that Powell said this week, that they probably would have cut rates already had it not been for the tariff uncertainty. So there's a lot of challenges ahead of us, and the market seems to be brushing them off. So maybe they believe that what the end game is going to be here will be a big, beautiful economy.
Well, it's interesting.
We'll see.
Yeah, we will see. And, this is where the Wall Street strategists earn their money. Michael Hartnett, who's a longtime strategist with Bank of America, is considering all of those factors that you talked about, but also the surge that we've seen in the market, which he's making the argument has put the S&P on the verge of triggering a sell signal. Given all your years of experience in monitoring the markets, what are those determining factors when it comes to what might derail a market that has had very few down days over a period of time?
Well, he's got a July 9th deadline, so that's one trigger on the tariff front. So these are fundamental arguments. He's also got we've got interest rate issues, as you've said. The deficit is going to be increased based on the passage of this bill. I'm concerned about that. You know, it's interesting. A lot of people don't realize this, that over 30%, and I heard a number as much as 37% of the U.S. debt is a result of tax cuts in the U.S. So he's continuing along that same theory that has gone across a number of different presidents and Congresses over the years. And that's a real problem. At some point, they're going to have to deal with that. So those are the kinds of things. That may be one of the reasons why the futures are down. Basically, they're not open today, but the futures are down. They're trading 24 hours. So we'll see how the market reactions on Monday on this. You got the bill that came through, and then you've also got the issues related to interest rates, and you've got the tariff uncertainty, and he's, as you said, increased some tariffs over the last night. So it depends on his mood, I guess, over the weekend. Hopefully he'll have a nice one, and he'll settle into something calming next week. But that's probably what's driving. Those are the triggers that are going to take the market lower. There's no question about it. Correction wouldn't be unhealthy, to be really honest. So.
Well, I want to ask you a follow-up on that last point, but
Sure.
To your point, I mean, look, this is the world we're living in right now, and even the president, to your point, I think what he said to reporters was that there would be about 10 or 12 letters that would go out today notifying countries of U.S. tariffs. So, after months upon months of trying to sort of do the math on what exactly each step means, the the markets still seem to be trying to figure it out. But on that point about corrections being healthy, generally speaking, like what are you going to be doing in the next few months? Because, like tech's a great example. We're going to talk a little bit more about tech coming up. But, you saw a lot of the high flyers lose momentum earlier this year, and then investors roared back into those sectors after the sell-offs. If you're anticipating that things, could take a dip lower, how will you be approaching all of that as an investor?
When I enter positions on behalf of clients, what I typically do is we'll take a position in a stock. For example, one of the ones we're looking at that we're doing right now are the banking sector. That's been more of a focus for us, particularly in the U.S. So I'll go into something like Goldman Sachs as an example. We will buy shares of Goldman Sachs, but we will sell a call option and a put option against it so that if the stock rises, I've got a nice return over a short period of time. If the stock declines, I have an issue that relates to I can buy more at a lower price. So I basically can dollar cost my average into it. As I'm in a position, what happens right now is that we are dealing with taking money off the table through the sale of covered call options, which tends to limit our upside. But because I think we're in sort of a corrective mode here, I think we need to get some stability. I tend to write short-term options. And on some of those high flyers that you spoke about, the premiums are pretty rich. So you can get a nice cash flow, which is tax advantage to investors, to deliver to them as we await things to move out. It's not getting in and out of the market and trying to trade it. It's just basically trying to smooth out the volatility as we move forward. That's the idea.